I think we shall start. So good morning, everyone. Welcome to our webinar for the new corporate tax law in the UAE. Today we have Ashish. He will be taking us through the new corporate tax law and what exactly the new the new law, how are we going to benefit from it, how going to be the companies are benefiting from it, what is the pros and cons. We will have also a kind of a general idea on how the companies should act with the new law. Just introduction about Ashish. Ashish, he is head of BDO's tax practice in the UAE, along with Oman and Bahrain, having hands-on experience of managing corporate taxes and withholding taxes practice in Oman, alongside overseeing VAT implementation in UAE, Oman, and as well as Bahrain. Ashish has an extensive experience of direct and indirect taxes, which could be relevant for the first time implementation of the corporate tax in the UAE. Ashish also specializes in advising on cross-border transactions to effect of optimizing overall impact from direct and indirect tax perspective. Again, would like to thank everyone on attending the webinar. And Ashish, I think we can go ahead and start with your presentation for today and take us through the new law.
Thank you so much. Pleasure to be a part of this webinar for today. I am the tax partner, as I said, and will be taking you through the basic the concepts of the corporate tax. A few things before I start. That as of today, we just have a publication from the Ministry of Finance. The law and the regulations which will give the detailing of the corporate tax is not yet out. So the date on which the corporate tax is going to go live will be the 1st of June 2023. And as per the news articles, it is said that the law and the regulations, that is the fine print, will be there at least 1 year before, for us to give a reasonable amount of time to prepare for this new law. So what I wanted to set it out right at the start. Yes, there will be a reasonable amount of time given for the preparation of the new regime overall. So there is nothing to be worried about. While this will be the first time UAE will be seeing like a corporate tax, because within the GCC member states, UAE and Bahrain were the two jurisdictions where there was no concept of a corporate tax locally. But now, with the publication that we have in the public domain, there are certain broad parameters of the corporate tax regime which have been made clear. And the purpose of the webinar for today is to just share with you that what is going to be the concept, what are the few things that we should be bearing in mind, and more crucial, that given that we will have some time for go live, do we have some kind of a window to structure or reorganize your businesses in the meantime, so that this new regime may not be so burdensome to you. So with this a little bit of a context, I'll go to the detailing. So the 1st of June 2023 will be the date when the CT regime will be going live. Now I have a specific slide on that how do you get covered if your financial year is say Jan to December. So I have a specific slide on that. Then surprisingly, to the consultant fraternity, I would say that the CT regime has been made equally applicable to local as well as foreign businesses. If I look at few of the jurisdictions, say Saudi Arabia, or Qatar, or for that matter Kuwait, there is a CT regime, but the CT usually is limited to most of the foreign shareholdings, and locally owned, I mean, businesses are not subjected to a CT. But here, to the surprise of all of us, UAE has made a publication saying that CT will be equally applicable to all, that whether the business is done on the mainland or whether the business is done on the free zone. The second part, don't be so worried about. I will be spending some time on how this new regime will commingle with the concept of the free zone, and it may not be so bad as it sounds. Then, as of today, they have clarified that the regulator will be the Federal Tax Authority, which is the same body which overall regulates the VAT kind of a regime as of today. So we have got a VAT thriving for quite some time now. We are soon going to get into the corporate tax regime, and it is going to be a very, I would say, a good time for all of us to see that how this, the transaction from so-called a tax haven will be done that to a mature corporate tax regime. So a very brief kind of a summary over here. Okay, usually a corporate tax will be payable when you have a profit. Okay, and how do you determine that whether you have a profit will be ideally driven by the audited financial statements. Now, what we have as of today in the public domain, that the standards of audit will be there, which will be used to determine that whether a company has a profit or not. Then there will be a local set of laws which will be saying that which are the things that you are supposed to do a plus minus from them. That is where the UAE CT law and the regulations are going to come. Then you will come to a taxable profit, and you will pay an applicable rate for that. Now, what the announcement clarifies is that if you have a profit which is the taxable profit going up to 375,000 dirhams, then you will not be subjected to a CT, which is the same, the threshold which we have for the VAT law also as of today. Then the profits after the 375,000 will be subjected to a 9% CT rate. Okay, what will be the threshold for small or the businesses which qualify for some kind of a benefit that is not known at this point of time? But further to that, if your business is a very large one and you have been using the jurisdiction of a UAE to maybe shift your the profits and not being subjected to a CT, that is the place where your structures have to be revisited. So there is a concept globally which is now going live, which basically says that there will be a 15% minimum CT globally on your global profits. So if your group overall on a global the turnover side is going to cross a threshold of 750 million euros globally, then this 15% global minimum tax will be applicable. So if you are in that bracket and your presence is in the UAE, then the 9% rate is not applicable. There will be a higher rate. As of today, the rate speculated is going to be the 15% in line with the global OECD standards, but the exact announcement on what that rate will be done in the due course as we have the law and the regulations to move on. So just to give you a summary, that yes, there will be a CAT. The general rate will be 9%, and the 9% will be applicable only if you have a taxable profit above $100,000 or 375,000 dirhams. And if you are a very large multinational corporation getting into the OECD Pillar 2 BEPS, then you may have a higher rate which has not been announced as of today. Moving on. Now, this is a very, something that you should be focusing on, that they say that the CT regime goes live on 1st of June 2023. So this is applicable from financial years starting on or after 1st of June 2023. So suppose if you are a business following a financial year of January to December, then the first year when you are going to be subjected to the CT shall be 1st of January 2024 till the 31st of December 2024. So that will be the first period for which you are supposed to file a CT return. Now the CT return, as per our experience in the GCC region, usually is due within 3 to 6 months of the end of the financial year. So assuming your business is getting covered in this regime, okay, the first CT return that you may be required to file will be there in the Q1 or Q2 of 2025. So just to give you a comfort over here, that yes, we have got some time to plan for this, not that this is like a VAT that you have to be completely ready to raise an invoice as on the 1st of June 2023. It will be driven by the financial year. So similarly, if your business follows the financial year of April to March, then the first time you will be reporting will be somewhere in Q3 of 2025. So the first period will be 1st April 2024 till the 31st of March 2025, and the return is going to be ideally due within 3 to 6 months of the end of the financial year. Now, whether you have a loss or a profit, ideally the CAT return should be filed. Okay, if you have a tax payable, actually, then the payment also goes with the return. What the announcement has fortunately clarified till now, that there is no concept of a provisional return or a concept of advance tax. There will be a situation where you will file the return, and ideally the return will be filed after the payment of tax, if any. So this is a very crucial point to note, that what will be the reporting period and when ideally the CT returns are going to be due. Moving on, fortunately, given that this CT regime overall will have far-reaching impacts, especially on certain businesses which are historically within the CT net, as certain banking operations are covered in the CT net at the emirate level. Okay, so this is being clarified that this will be covered as a part of the the CT net, and more importantly, they have clarified that if it is an individual who is doing a business, and if that business needs a license, then that individual's business is also getting covered in the CT net. While they have clarified that salaries and anything that you are earning as an individual based on the profits or anything like that, that is not subject to a corporate tax, because it is called as a corporate tax. It is not a personal income tax. Okay, this is not going to be a tax on your salary, but this is a tax going to be on your business, which you are going to earn from the profits, and then you should be liable to pay the tax. So this is a very crucial point to know, that if it is a freelancer or if it is an individual who is having the business, then they should ideally be liable to the CT regime also. Now here I would like to spend upon 1 minute on a very crucial point. So as we would know that a lot of foreign businesses do business in the UAE while they don't have a presence. Okay, while from an electronic service perspective or from a VAT perspective, these businesses may have a non-resident VAT registration and they will be making good the VAT liability. But under the corporate tax laws of the region and worldwide, there is a concept called as permanent establishment. So suppose if you are a foreign business and you are doing some business in the UAE, depending upon the rules that might be clarified, you may be subjected to get a corporate tax registration even if you don't have a license. Okay, if that be the case, then it could actually make sense for you to set up a presence. It could makes sense for you to actually set up a presence rather than operate on the basis of a permanent establishment. So as we move ahead, as the law and the regulations are out, this point also will be clarified, that how foreign businesses who don't have a license, who don't have a presence in the UAE, how they will be treated from a CT perspective. Then a few of the things that the publication has clarified as of today, that if a business is earning a dividend or capital gains, ideally from a UAE business, okay, then that will be exempted from CT. So if there is an investment company and the investment company's job is to earn only dividends and capital gains, then these so-called benefits are not going to be liable to CT. The fine print on how that will be determined from the taxable, the turnover will be given as the law and the regulations are out. Now, the last and the crucial point is that there is one point which says that if there is extraction of natural resources, okay, that will remain at the emirate level. That may be for very large companies. But moving on to free zones, most of the UAE the businesses have been set up into the free zones, given that they allow 100% foreign ownership, or there was a kind of a commitment given by the free zone regulator saying that you will not be subjected to CT. Now, this point is very crucial. Please hear to me very carefully. Now the commitment given by the free zones are going to override the corporate tax regime. This means that if your business is there in the free zone, your business will not be subjected to CT even if the CT regime goes live and you are getting covered. This comes with a very big rider. The rider is that, okay, first one is that this will be driven by the number of years commitment given by the free zone. So if the commitment given by a particular free zone is say 50 years, then for the 50 years, whether it is going to be a balance or whether it is going to be refreshed done on 1st of June 2023, we don't know. But on a conservative basis, the balance years you are not going to be subjected to CT, and that's the first point. So it is a period driven condition. And the second one is that the free zone should not ideally be doing any business on the mainland. Now, this as a concept, when it comes to the UAE, remains as a concept and it is not strictly followed. So if like a company from the free zone does a business on the mainland, it is being done rampantly. But with the CT coming in, please note that you will lose the CT benefit of free zone, means that the business or the profits that you are earning from your businesses are done on the mainland will be subjected to CT even if you are in the free zone. The logic is that ideally the concept of a free zone is used by way of which exports are promoted. It can be export of services or it can be export of goods outside of the UAE. So UAE gets foreign exchange. But the CT benefit is going to be lost if you are going to do the business in the mainland. Now, having said that, all of this at this point of time are speculations and based on our experience of working in a market like Oman, where we have free zones and a corporate tax regime functioning for a long time. Having said this, UAE being a very business friendly jurisdiction overall, there could be further relaxations which will say that this may not apply or may apply. But if it applies, it may get a little complicated because the business in the free zone will have to segregate your books into what business has been done outside of UAE and what business has been done on the mainland. And accordingly, the profits earned from the business on the mainland will be subjected to CT is our speculation. But we will wait and watch as the law and the regulations are published in the due course. Moving ahead, fortunately, similar to that of a VAT group, okay, the CT law also talks about a tax group. But this is something that I would like to clarify While from a VAT perspective, you may have a VAT group, which means that you will have only one VAT registration number. But from a corporate tax side, there is a possibility that your corporate tax registration number will be driven by the license number. Means that each and every license will have a different corporate tax number. But what the law will certainly allow is that if one of the companies in your group has a profit and other one has a loss, rather than paying tax in one, you should be allowed to set off the tax losses within the group. That is what this says. However, we will wait and watch that whether this grouping will be as simple as a VAT or whether this will remain as a separate one. And on on a group level, the payout of the CT could be optimized if you have several setups done within the UAE. Now, what we have seen in the mature jurisdictions, that as you know, your profits up to 375,000 AED are not liable to CT. People get into this various structuring models where they set up various entities and then they claim the benefit of this minimum threshold. So this also can be explored as an option, but obviously setting up more companies, more licenses comes with a cost. And one of the aspects which I should make very clear at this point of time, that when it comes to the filing of the CT return, okay, our view says that whether you are a company from a mainland, a company from the free zone branch of a foreign company, all of you will be subjected to CT filings. You may not actually pay the CT, but you may still be subjected to CT registration and CT filings. Now, how does ideally a CT filing shall work? Ideally, a CT filing works on the basis of an audited financial statements, which similar to the thing of doing a business on the mainland, getting audited financial statements is, means at times taken a little bit lightly. So going forward, getting an audited means the financials and submitting a CT return may become crucial. And especially from the aspect of free zone, if you are in a free zone and if you have certain tax losses in your exemption period, okay, please note this, then ideally, as per the CT laws in the other jurisdictions, this losses can be carried forward for an unlimited time. So for you to record the losses for a particular year in that exemption period, you will still be obligated to get a CT registration and file a CT return. Now, here, as we have seen in the VAT regime, that well, the law may not be so complicated, okay, but the overall mindset of FTA, okay, is such that there are a lot of procedures and lot of penalties which get levied automatically. Now, if that be the case, while this CT regime may not look very complicated, but it may add a little bit of a compliance burden on your level, where you need to get CT registration, you need to get audited financial statements, and you need to file the CT returns also. Now, with this, there is a little side point from an audit perspective, as you would know, in the UAE, for smaller companies, they use IFRS standard, which is applicable for SMEs. So at this point of time, not really clarified that whether the audited financial statements should be as per full-blown IFRS or whether they can be on the basis of the standard which is a toned down version, which is IFRS for SMEs. So whether that will be used or whether you will need a full-blown audited financial statements is something that we should wait and watch. Moving on, fortunately, the publication has clarified that there will not be any withholding taxes. See, because if you have got a profitable, a company within the UAE and you want to plow back the profits in the form of a dividend, okay, then ideally dividends or such kind of service payments also before get subjected to a withholding tax. But it has been clarified that UAE is not planning to implement withholding tax. But on the flip side, okay, if you are a company based in the UAE and you are providing services or any other things to companies in the region or across the world, the UAE companies were presently getting subjected to a withholding tax. Now, with the CT regime now coming in and assuming that your company in the UAE is subjected to CT, then the withholding tax done in a foreign jurisdiction on the basis of a certificate should ideally be allowed as a set off. So this may not be so bad. Okay, we can look at certain structures where the withholding taxes which were currently cost in your business model are now becoming creditable, so that your CT outflow from a UAE perspective may not be so much as high as a 9%. So it can be optimized. Moving on with the CT means regime, there is a mention about an official transfer pricing regime also. In very layman terms, what does a transfer pricing mean? That if you are dealing with a related party, a group company, or transaction should be at arm's length and it cannot be done at cost. We have observed a lot of regional businesses based out of UAE, because UAE is a jurisdiction where availability of labor is more. There are certain cross charges done from a UAE side. Now the cross charges, okay, are ideally done at cost. But now with the CT now coming into play and concepts around the transfer pricing also coming into play, the recharges may not be able to be done at cost. There should be a markup and there should be a transfer pricing study. What level of compliances will be there in the UAE, we need to wait and watch, because as of today, this is just the one line. They just said that there will be a transfer pricing regime. How and when, or what will be the threshold for administering the transfer pricing regime, we will have to wait and see. I spoke about the visa compliances. So you will, have to get a registration. You will have to do the compliances, even if you are a company from the free zone or the mainland, is what we think. But we should wait for the law and the regulations to come out. Now, there are certain these are key takeaways. See, as of today, we just have a publication and that gives a framework. There are certain things that you should note from as of today itself. That the first point is that while the publication says that your profit will be based on accounting, the profit, but there will be certain nuances in the UAE CT law which say that certain expenses are not allowed, such as something like provisions, something like bad dates, something like payment to the shareholders. Okay, if you are making a huge amount of a payment to shareholders, ideally, as per mature jurisdictions, that entire expense is not allowed as deductions. It is added back to your taxable profits. So there could be certain, certain areas which we can study at this point of time and see that how you can optimize it from a CT perspective. The second point I spoke about is that if you are a business who is looking at setting up into UAE, okay, and presently don't have any setup, but are going to provide services, or maybe certain services supplies will be done by your local branch and certain services will be done by your head office in a foreign country. Now, if that happens, we have seen structures in the region where your local branch also gets a CT registration for their part of the work, and then the foreign office is also obligated to get a separate CT registration because the foreign office creates a permanent establishment. Now, when we look at a concept like a PE, then we need to look at concept like double taxation avoidance agreements. There are a lot of countries with whom UAE has signed a DTAA. So we will need to look at and study that whether your foreign business is getting exposed to a PE, irrespective of a fact that whether you have a local presence or not. Now, the next point is about the salaries paid to the shareholders. The next point is about the depreciation. So as we know that if your business is going to have a lot of assets, there are going to be the depreciation standard followed as per IFRS. Now, as per the CT law, okay, there might be certain different standards. Okay, there could be accelerated depreciation, or the depreciation may be a little slow. There could be a pooling method. So there is always going to be a difference in your depreciation as per IFRS and depreciation as per tax books. So depending upon your profit before tax, you will have to add or subtract to come to the taxable, the profit. So this is also a key area where now the depreciation has to be maintained on an asset wise. Here an open point is that what should be the written down value as on the 1st of June 2023, that whether that will be the book value, or you need to get a business valuation or a asset valuation. For that we need to wait and watch. Next, I spoke about the concept of the transfer pricing. So yes, while this is just a line, but I would say compared to that of CT, the domain of the transfer pricing is a very larger one. From the consulting fraternity also, ideally we have a separate team for direct taxes, which includes corporate income tax, withholding tax, and a transfer pricing, and from an indirect tax perspective, which includes customs, excise, VAT, and other taxes. So this is a very specialized area which needs a lot of study, and then they will do like a comparable study and come back to you with a margin, that what a particular business should ideally be charging as a margin when you are dealing with a related party. Uh, the next one is that as certain, a part of dividends and capital gains are defined as exempted. So similar to the concept of the VAT law, if you have a situation that if you have certain expenses which are related to this exempted income, then they are not allowed as deduction from a tax perspective. So while you may get happy about the fact that, okay, these revenues are not subjected to CT on the output side, but you also need to look at expense, then these expenses should ideally be disallowed too. The next point is, and this is a little bit a complicated one, I would say, that if a business is going to be debt heavy, okay, then there are certain restrictions on claiming the deduction of interest expense, as the company is in the business of taking loans and giving loans. And if the loan on the outward side is given interest free, given that this loan is given to a group company, those are the areas where interest expense for this company may be disallowed. Now the next point is about relief of bad debts. See, as your IFRS standard may not really give you the benefit of bad debts or create a provision, but from a CT perspective, provisions are disallowed. So how do you get the benefit of bad debts is a very crucial thing. This is also a crucial thing in the VAT law, that if, and especially in the times of COVID, we have seen that bad debts is a big thing. So what will happen, that you will end up paying a tax on certain monies which you have not earned. So looking and the planning around the bad debts is also a crucial aspect. The next point is to look at the the deductions. Okay, if you are going to make such certain CSR spends, if you are going to spend for some vaccinations, blah blah blah, whether they will be allowed as deductions. The next one is to study the, or to liaise with the free zone licensing authorities and check that how does this CT will be administered. Okay, because how it works, at least from an Oman perspective, is that there is an application which is made to the free zone licensing authority. Okay, they study it, that whether this business should be eligible for exemption. Then they from their end make a recommendation to the tax authority. Okay, and then the tax authority specifically gives me a license as a free zone company, saying that for so many years you will be exempted from tax. So there could be a lot of procedure around this, a lot of red taping around this. So we will have to see and study that. The next one is what I mentioned earlier is about the thin capitalization rule, that if you are taking loans and giving loans and your debt to equity ratio, your debt is certainly high, then there could be certain implications from a CIT perspective on that. Last but not the least, the vision of the BEPS is a pillar two by having a global minimum tax of 15% is that the the concept of you provide or your business proving an economic substance in UAE may finally go away, because as now the business will be subjected to CT and specific transfer pricing regulations, then there may not be a need for economic substance. So our view says that as we move ahead, we will have a mature a corporate tax regime, we will have a mature transfer pricing regime, we will have a mature VAT regime, and these concepts, which are a little bit burdensome, like economic substance, CBCR, may fade out eventually. Now, what we can do as of today, okay? The first and the crucial point is that with this kind of CT coming into the play, okay, you will have to check what is going to be the implications on your overall group structure. If you are functioning through a lot of legal entities, like I've got into a couple of calls where there is businesses on the mainland, subsidiaries in the free zone, a free zone having branches in the mainland. So you will have to look at each and every standalone license separately and evaluate your CT obligations. The next one and the crucial one is that, see, VAT is usually a creditable tax. 99% VAT credit can be claimed subject to the thing that your business is not exempted. Okay. But when it comes to CT is actually a cash outflow. So given that if you have a cash outflow, then you need to understand and simulate numbers and see that if my company is profitable, I need to pay the 9% or I need to pay the higher rate. That is actually a cash outflow. There is no credit or anything like that. So we need to specifically look at numbers and take commercial decisions over here, that given that I am now obligated to pay a corporate tax in the UAE, does the price of my products or services go up? The next one is that from a corporate tax side, you need to look at policies, procedures, systems. You should be having trained resources or outside consultants to take care of your overall CT filing. Okay. Then there could be certain requirements such as the compliances to get registration. And last not the least is that you will have to do a transfer pricing study. Now, the threshold for the transfer pricing is not known at this point of time. Usually, the transfer pricing requirement is there for the businesses which are really having high volume of turnover, may not be applicable for all. So it could go in the range of 500 million euros and stuff like that. It may not be applicable to all. So this may not be a requirement which everybody could have. And then we can provide trainings like this and full range of advisory services. So what we are doing as of today, that looking at your business structure, we can come back to you the areas that you should be focusing on now and carving out those areas where we need a clarity. When the laws and the regulations are out, we can quickly fine tune those and make you ready for your first CT filing, which ideally will be due in the year 2025. So with this, I will take a pause. If there are questions in this regard, please to take them.
Thank you so much, Ashish, for the very detailed presentation from your end. Was really insightful for having you, and pretty much you have covered all the aspects. However, for our attendees, we do have some questions, which we'll go through it now. We will start with Alok. Alok Kiria, there is a question mentioning that whether the company is incorporated in the free zone is subjected to the CT.
Yeah, so short answer is yes, okay, but this will be driven by the commitment given by the free zone authority. So suppose if you have a 50 years exemption, then you will not be subjected to CT, means that you may still be required to get registration, you still may be required to do audit, still may require filings, but still that CT may not be paid out in cash. So the free zone commitment will override the CT regime.
Okay. Alok also having another question, which is at present, we are not getting the books audited. So will we need to get it audited compulsory or no?
Auditing part of the, I mean, the requirement will ideally be compulsory, because as a CT, a regime will follow auditing or standards. So the audited will be a mandatory. Now, what type of audit is going to be used is going to be a key thing. That whether it is going to be as per IFRS, the toned down version, or it will be the full blown version. But yes, getting an audit done ideally looks to be mandatory. It is not formalized until now, but based on our experience of other regions, it looks like it will be mandatory.
Okay. Alvina also is having a question, which is explanation of the rates, slabs, and tax rate related to the new tax law.
Yeah. So till a taxable profit of 375,000 dirhams, you are not going to be subjected to CT. Okay. Over and above that, you will be subjected to 9%, subject to the fact that you are not a part of a large multinational group whose global turnover is 750 million euros or more. If you fall into that higher bracket, then the announcement says that there could be a higher rate. That higher rate is not announced. So as of today, we have two rates for a medium and small business, that it could either be zero or it could either be 9%. And this will be overall be governed, if you're a free zone entity, then the commitment given by free zone. So I would say that you may have a high chance of falling into the 0% bracket.
Great. Mark as well is asking for how will the free zone entities be treated differently from mainland?
Yeah. So there will be a difference because the free zone entities will be driven by the commitments given by the free zone licensing authorities. Okay, so they may not be subjected to CT. Companies from a mainland, whether they are doing a business in the mainland, whether they are doing business in free zone, or whether they are doing business outside of the UAE, everything will be subjected to CT. So means from a overall regime side, the setup in a free zone is kind of protected by the commitment given by the regulators over there, but a business in the mainland is completely exposed to CT from the first day itself.
Great. Another question, which is Mehreen is asking, will accounts need to be finalized by an external chartered accountant, or internal produced accounts will be accepted?
Well, it is not expressly laid out, but our experience of the larger GCC member states, ideally the accounts have to be audited by an external auditor, and who should ideally be licensed in the UAE.
Good. I think another one from Mohammed, audit needs to be done by internal finance team or through an external source?
Same answer. It will be ideally through an external source, but we need to wait for the fine print.
Alok, can an Indian CA do the audit of the company?
Ideally not. Your firm should be licensed in the UAE as well.
Kumar question is the same as we have already explained earlier. Okay, Saleh is having a question. Companies owned by the locals, are they taxed as well?
Yes, this has been specifically clarified, that whether the shareholder is coming through local Amaratis, or whether the shareholders is being the GCC nationals, or whether shareholders are foreign, all companies will be treated at par. So going forward, the decision of having the company on the mainland vis-a-vis free zone will be the key into determine that whether CT will apply or not.
Great. Alok, another question, which is if I am providing services from the free zone company to a company incorporated on mainland, so the income from those services will be charged to CT. So we will need to
That's right.
maintain two types of books, one for export income and another one for mainland clients.
Unfortunately, yes, that will be the complication. Now, let's see what UAE does as a magic as they do most of the times if they try to simplify it or give some kind of a threshold that you can do so much amount of a business in the mainland and still you are protected from CT perspective. So we can wait and watch for that.
Which I believe the same is happening because this is what exactly usually we're expecting from UAE. So pretty much we are done with our questions. Thank you so much, Ashish, for having a great kind of presentation and taking a very smooth explanation about the new law. Yet it's not finalized, but of course we are looking forward to a better kind of a version and finalized version for the whole corporate owners in the UAE. Thank you, our attendees, also for joining us today. Please do let us know in case this is not like the question is still having any questions or anything. Please, you can reach us out to our number, which is 800-249, or you can drop us as well an email at marketing@businessincorporation.ae. You can also drop a kind of a question or direct a message to our social media accounts, or you can, of course, contact Ashish at any time. He has already shared his details. Our session will be uploaded as well on YouTube if you would like to catch up again to have a kind of a full, if in case you missed to join early. Thank you again and have a great day ahead. Ramadan Kareem for everyone.
Thank you. Ramadan Kareem to all. Thanks. Bye.